Hello and welcome to Bondcast, a podcast series where we discuss the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global market specialists, Giles Gale, Theo Chapsalis, and Jan Nevruzi. Before getting into today's discussion, I just want to quickly remind you to hit the subscribe button so you can listen to all our latest episodes as soon as they're available. All right, Theo, I'm going straight in with you because we've had a very exciting few weeks in the UK, but I guess this was the kind of main event this week with the Bank of England. We had the call for no hike, which was going against market pricing, which was 100% price for a 15 bip hike today. And the Bank of England did not hike. So good day to be a UK rate strategist at NatWest Markets. What was their rationale for not hiking, given that it felt like Bank of England MPC members had kind of talked the market into believing that a hike was coming?
Sure. I mean, thank you for the compliment. I would rephrase it: a good day to be, supporting or to be covering the UK market at NatWest. Either that's my colleague Ross Walker or me, because it's something that we do a lot together. So I think the rationale for not delivering the hike is really one, what is going on with inflation, and inflation is seen largely by the BOE to be transitory, and this is important. And transitory does not mean necessarily 1 month or two. The BOE made a clear case that if inflation is higher in the 1 or 2 year horizon, well, this is still transitory. Policy is being delivered in order to steer expectations in the 2 to 3 year horizon. So this is one reason. The other reason is really related to the labor market. And when we look at the data, well, the BOE, they feel the need to receive more information before delivering a hike. So they said that hikes are coming, and we don't disagree. We actually think that hikes indeed will come, but it's a question of time. And clearly the time is not now. I think the other reason is really that, the BOE, that didn't feel that the risk reward, that the risks are indeed favoring a hike right now. And they mentioned that the need to hike needs to be very closely, very carefully assessed, as it will have implications with regards to the labor market. And the BOE, they're definitely concerned of overhiking. So this is the other very important point. And it tells us that the BOE, they've looked at also other forward rates. And at some point, by the way, some of the forward rates were pricing a bank rate of 1.5% in the 2 year horizon. So there's been a lot of optimism. And I think that the BOE, they were uncomfortable with that pricing. So there are different reasons, but mostly they relate to the transitory nature of inflation, to their view on the labor market, and, the timing.
So talking about timing, then you say we do think that rate hikes are coming. Can you kind of, I guess, put some context around that? When do you think they're coming, and how much do you think is coming?
Yeah, sure. I mean, first of all, we don't think that a rate hike will be delivered this year. This is why heading into the meeting, we've been saying that the market, where they price this December meeting, where they price this SONIA rates, well, that looks high to us. Now, next year at the February meeting, yeah, we do expect a 25 basis point hike at that meeting, followed by another 25 basis point hike at the May meeting, and then another 25 basis point in November. So hikes are coming. The BOE, they will have to deliver some form of policy accommodation. To remove some of the policy accommodation that they delivered. But it is really quite later. And this has got obviously implications, especially the hike. If it is the first hike, if it is pushed to February, it means that the bond that matures in March, that bond will be reinvested. And this is one really hot topic, right? So we think hikes are coming, 3 hikes next year, 15 basis points the first, and the other being 25. By the way, the 2 members that voted for a hike today, they voted for a 15 basis point hike. So even those really very hawkish members, Saunders and Ramsden, well, all that they've called for is 15 basis point, not 40 basis point. So this is also why we see 15 basis point hike in February, and then 2 25 basis point hikes later in the year.
We've got so used to talking about accommodation that it feels weird to be talking about tightening all of a sudden. So I guess then just to wrap up the BOE discussion, I would just want to know what implications you think this has for markets. You know, you've for a couple of weeks now had on this kind of cross-market trade, so being long gilts, being long the UK versus the US and Europe. Obviously, that's done well today. Do you think there's still further to go in that trade?
Yeah, absolutely. So gilt strength has been a theme of us, and as you've correctly alluded to, this is really where we see some potential. I mean, we've been sitting on the fence with regards to the level of rates, and well, we don't think that there is much potential in terms of absolute level, but we think that there is a very specific UK story here, and this relates very much to net DVO1 and net DVO1. Well, after November, it is falling because let's not forget what happened, on the 27th of October with the budget, right? So less gilt issuance in general, less gilt issuance until the end of March. Now, what it means as well, so what we got from today is that, if we get those reinvestments, this 28 billion being reinvested, some of that will take place in March, some of that will take place, in April. And well, depending on the pace, so we will have very supportive reinvestment flows across gilts, and this is something that reinforces the asset class. Also, if we think about it, as we head to the year end, de-risking activity is likely to pick up. So risky assets are at very elevated levels, equities, and the switch out of equities into fixed income looks particularly attractive. Now, well, that switching will not happen at the front of the curve, but it will happen at, longer maturities. So this flow will definitely support UK duration, and this will be felt, well, both in terms of curve. So this can support some flattening, say, for example, in 1030s. But the way that we expressing it is really the cross-market view, because we think that in the 10-year sector, for example, it is a sector where you have liquidity, and then you can have, gilts being stronger than fixed income in other geographies.
The Bank of England wasn't the only central bank in town this week. We had the Fed too, although it seems like it's been a little bit overshadowed by today's events, but we haven't forgotten it. So Jan, what did we learn yesterday? They obviously announced the taper as expected. Were there any kind of surprise elements or market moving elements or just kind of interesting points that you want to kind of give your takeaway on?
Yeah, so two really main things around this, around yesterday's Fed meeting, which, like you said, looking at the market moves is pretty much overshadowed by what's happening in the UK, but it's dragging US markets higher, lowering yields as well. But two really main things that I would stress from yesterday's meeting. The first was on taper, as expected, and it was pretty much very clearly communicated. Taper has been announced exactly at the pace we're expecting, 15 billion a month of reductions. So that's split 10 billion in treasuries, 5 billion in MBS. We know that they're going to start from the mid-November announcement for the asset purchases. But interestingly, they also gave us a purchase target for December, but nothing beyond for December with the same pace. We are supposed to assume an automatic kind of monthly reduction. They have the flexibility to adjust, of course, but for now, it's on a monthly basis. But it was interesting they didn't give anything past December. It just they don't want to pre-commit to anything in next year, which makes the December meeting more interesting, and B, gives them room to speed up if necessary or slow down. But looking at the kind of like the macro environment, risks towards increasing the pace are higher. So what does that mean? Well, the narrative that the Fed was trying to kind of provide to the market earlier, which was do not associate the end of tapering with timing for liftoff, is sort of gone. Now markets will, by definition, it probably is the number one item on the dashboard if we want to measure when the first hike will be, is the end of taper. And if we get a message that they speed up, let's say in the December meeting, they're planning for January to go a little bit faster, then we definitely markets will definitely price in even earlier hikes, pull them to like a little bit earlier than, who knows, maybe even mid 2022. So that whole don't rely on end of taper as the timeline for hiking is gone. But otherwise, the details were pretty much as expected. Nothing really that caught markets off guard with respect to the details of the announcement. The other thing was the language around inflation, which is what I really think drove the market action. And what we got there was tiny, subtle changes in the statements, saying inflation is elevated, largely reflecting factors that are expected to be transitory. I think that is sort of consistent with the messaging that they gave us before, the messaging that we've been receiving from both Chairman Powell and other officials before we entered the blackout period for this meeting. Sort of like inflation is transitory, but uncertainties are higher. We know it's going to go away, but now we have a wider band of uncertainty around how quickly that's going to happen. So that was reflected in the policy statement. It's a small change, but not something markets ignored. And on the back of that, the long end sold off and the curve steepened. Other than that, the press conference didn't have that many fireworks. Chairman Powell kept it pretty vague. He got asked questions on, do you think the hike pricing for next year is right? Not really much on that. On things like, is the Fed going to speed up tapering or slow down? He said that they can do both. There's no really answer right now. On inflation, he said it's driven by bottlenecks, but risks are skewed to higher. So nothing there. But one interesting thing from the press conference was his timeline for when they think inflation would subside or show signs of subsiding was Q2, Q3 in next year. So that sort of gives an unofficial runway to the Fed to claim transitory has won or it hasn't, which also happens to end by the time the taper is ending. So now I think markets should be looking for earliest hikes in Q2, Q3, as they are. Chairman Powell made that official. As a reminder, our first hike is in Q4 next year, and then we see 4 more in 2023. So those were my main takeaways from the Fed. It was not really an overly dovish meeting, but it certainly wasn't anything to the extent of what we got from other central banks like Bank of Canada or the RBA.
Yeah, it certainly feels like the Fed has been the least eventful, which is surprising when you think that they announced their taper, but compared to the other actions that we've had this week. So, well, that was a fairly complete roundup, I would say, of the Fed's actions. But yesterday, we also had the refunding announcement, which we talked about on the pod last week. Sorry, I should say we're recording this on Thursday, so yesterday being Wednesday for us. Was there any kind of surprises in that, or was that pretty much as you expected with the reduction in the coupon issuance?
So slight surprises where it didn't meet our expectations were in the reductions in 10s and 20s. And I gotta say, size-wise, the overall package that was delivered is exactly kind of what we have penciled in. 84 billion for the November-January period. 84 billion less in issuance for the November-January period compared to the 3 months prior. But what was kind of different than what we expected is we got a little more cuts in the 20s, 4 billion, and a little less in 10s, 2 billion. We expected both to be at 3 billion. And also tips increases in auction size for tips will be halted for now. Treasury will reevaluate that down the line. For 20s, it does make sense. That was a recommendation going into before the announcement. 4 billion is we thought it was slightly larger than what we expected as far as cuts go, because they might eventually have to stop cutting the lines and not, while the rest of the tenors are being reduced, just because otherwise the auction size will dwindle to like a very small amount. And for the 10s, it's understandable. It's not really, I wouldn't say it was like a massive shocker, any of those. We were on the probably lower end of the expectations for 20s. That being said, 20s did outperform the surrounding parts of the curve after the announcement. And as far as tips go, we just kind of assumed they would go on almost like an autopilot, continue the trend from this year of increasing auction sizes, partially because the proportion of tips as outstanding marketable debt dwindled a lot after the COVID-related expenses. But also now a little bit in hindsight, we can see why the Treasury would want to stop with tapering about the commands. liquidity in the tips market not being great, and they probably want to gauge the market to see how it will develop. If there's going to be any indigestion issues, if there's going to be further kind of like any market dislocations in tips, and then see if demand remains robust, go into taper. I don't see why not. They could continue increasing auction sizes from there too. But that was really the crux of the refunding announcement. We started a round of cuts. The outlook around bills and debt ceiling is still uncertain, of course, because of debt ceiling. Sorry, I meant the TGA and bills is uncertain because of the debt ceiling, and that's sort of it.
Great, thank you, Jan. All right, over to Europe then to round up the trio of central banks, although I know we had the meeting last week, which we did go through on the pod, but we've obviously had relatively volatile rates since then. Let's start on the core side, because after we recorded the pod last week, on the Friday, European markets went on to price in even more rate hikes than they already had in before the meeting on Thursday from the ECB. So whether the ECB intended to push back on market pricing or not, they obviously didn't do a very successful job of that, but some of that pricing has been pulled back now, and we're pretty much back to where we were pre the meeting. So what's your take on all of that, Giles? Do you think markets are right to be pricing that in still, or is there further to go in pricing out those rate hikes?
I think I was fairly clear before that no, I don't think it's right. I think that there's a lot built into the front end which needs to be taken back out again, and obviously there was a little bit of disappointment, perhaps about the way that Lagarde dealt with the discussion about the front end. I mean, she could potentially have made some kind of effort to reformulate a little bit, or the nature of their reaction function, or possibly even hinted at measures to sort of address volatility or whatever it was. No, none of that at all. She basically just said, listen, our reaction function, it is what it is. We don't think that inflation is going to be what you think it's going to be. And so we don't think that you're right, essentially is what she said. And so it's like, well, the market took that and went, well, okay, well, we've been second guessing you. We're pretty happy about continuing to do that. If you're not going to push back any harder and it's just going to leave it down to what inflation turns out to be, that doesn't give us any security. So, that's where we were. That's why we sold off, I suppose. A bit of a disappointment. And then we came back, as you say. I mean, why? I think partly because valuations have become stretched, and it's what I've been repeating again and again. Partly, I mean, there has been a little bit more of an effort since the meeting, as there often is, just to kind of, even if the message is the same, just by virtue of repeating it, you kind of stand at least a little bit of chance of getting a little extra traction. I think, to a certain extent, that is what we're seeing. I mean, we had Lagarde yesterday again, just saying we don't think that we're going to be raising rates in 2022. Well, frankly, we don't think they're going to be raising rates in 2022, and probably not in 2023 either. Obviously, it's possible, right? But that's sort of where we are.
Yeah, I think it was interesting that she put kind of a specific time frame on it this time around versus what she said in the meeting. And it's also kind of interesting that both her and Governor Bailey from the Bank of England have adopted this line of it not being their job to kind of push back on market pricing or guide market pricing. Some would argue that it is, but there we go. So the other kind of interesting or more volatile move that we've seen in European markets over the past week has been the shift wider, and then has given some of that back, but the shift wider initially in periphery spreads, I guess, led by BTPs. What's your take on that? Do you think these wider spreads are justified, or are they overdone now? They have come back in a bit, but they're still obviously wider than where they started.
Okay, I'm just, before answering that question, I'm going to go back on what you were saying about the job of central bankers, and whether it's to guide markets or not at the front end. Listen, up to a point, they're right, obviously, but volatility is also something that, in general, particularly at delicate times like this, they want to try to avoid, right? And so, knowing where the market is and engaging with the market a little bit about that, can help, because otherwise you essentially you risk storing up bigger moves down the line. And the ECB became quite good at that with Draghi and Tretz, and it seems like they have lost that knack a little bit, let's just say. On Italy, I mean, we sold off significantly, largely because Lagarde was, she was fairly forthright in her expectation about the PEP being likely to end in March next year, and that arguably isn't particularly news. Nonetheless, there could have been more about what was going to take over from there, because obviously everyone has that as a potential risk in mind for BTPs, especially because so much is disappearing into the Banca d'Italia, into the euro system, that when that steps back, obviously somebody has to step up to fill that, but they're not going to necessarily want to do that at the same level that the euro system is going to. And so I think as we move towards that, unless there is a clearer guidance that there's going to be something reasonably substantial to sort of soften that step risk in March, then we're going to look increasingly towards that. And this is this year's theme, right? This is something that I think is likely to build into the ECB in December. This isn't a Q1 story necessarily. But I think that without the right guidance, we clearly do risk BTP spreads widening, and at the same time as rates are heading higher. And so you have just written a note about the high beta of BTPs, and I think that is spot on. Against that, of course, we have all the positive stories that we have mentioned again and again. So debt sustainability actually looks pretty good. The average rate of interest that Italy is paying on its debt is continuing to fall, and will continue to fall for quite some time, even if rates rise from here, because so much of that debt was incurred when rates were significantly higher than they are now. A lot of it is held by the euro system anyway, and that's gone for the long term. So all of these things, they're pretty supportive, and those aren't going to change. The other thing to say is it's always, I think, just useful to bear in mind what markets are actually implying for a sort of Italy default, leaving the euro area type situation. And at the moment, over 10 years, they are effectively pricing in around 15% probability. Okay, go away and think about that. I think that's pretty high given given the starting point. Over 30 years, we're talking about 50%. In fact, arguably more. And that is based, for those who like the technical kind of assumptions, that's based on a pretty low recovery in a default scenario. If the recovery is higher, say something like 40%, which is a sort of standard credit assumption, your probabilities of default are significantly higher than those that I've just said. Okay, so that's kind of your benchmark. I think you're still being paid for owning Italy, to be honest with you.
I agree. And a little bit of self-promotion there for anyone that is interested in delving deeper into all those things that Giles did mention. If you are subscribed to our Agile Markets portal, then you'll be able to see the note that I have just written on all of that. All right then, guys, I think that's probably all we've got time for today. So thank you everyone for joining me. And just a reminder to our listeners that if you like today's episode, don't forget to hit the like button and press subscribe so you get our latest episodes as soon as they're available. Chat next week.